What's up, guys? Giving it a couple more minutes just for everybody to join, and then we'll get started. Um, put any questions you might have in the chat, and I'll get to them as best as I can. We'll probably go over a few charts um, today or towards the end of this. But yeah, we'll definitely go over some charts for you guys. And yeah, if you have charting requests, just put those in the chat, and I'll make sure to get to those. But we're going to go over options contracts first. It's going to be pretty short, nothing too crazy. And yeah, it'll be pretty easy to get through. Pull my notes up real quick. Okay, so we're just going to get started. So the first thing, what we want to do when we're looking for contracts and options, we want to figure out what type of trade we're going to be doing or we're looking to trade. So, for example, we first, most importantly, want to be looking at a few different things. So we're going to be going over what in the money and out of the money options are, just the basics of what those are. Then we're going to be going over volume, open interest, delta, implied volatility. And that's really the main things you guys want to understand. And it might look a little different on different platforms, but the concept and idea are all the same. So we're going to start with in the money versus out of the money options. Okay, so you have your expiration. These are the days that contracts will expire. So there's like for SPY, because it's traded so often and it's such a heavily traded options market, they have things expiring Monday, Wednesday, Friday. But like if you go to Apple, they only have expirations every Friday. And this is a pretty well-known traded stock, but people typically are going to trade SPY, QQQ, IWM, these tickers more, and that's why they have more expirations. And there's more Monday, Wednesday, Friday expirations. So basically, what we're looking at here, that's how expirations work. This is when the options expire. And so you have in the money, out of the money options. So these blue here are in the money options for calls. And then same with over here. It's basically the opposite. So puts and or calls and puts are going to be the opposite effect. So like the blue here is in the money for calls. This is in the money for puts. This is out of the money for puts. This is in the money for or out of the money for puts. So basically what the concept is that all these ones in blue, if this contract or this at this expiration, SPY was to close at 413, right around 413.47, these contracts would be in the money and these would be out of the money. So the catch is with understanding in the money and out of the money, these at expiration, these out of the money ones here and over here would expire worthless. That's the idea, that these would expire worthless because they have no actual value in them. So when you're buying a contract, you're basically buying rights to shares. That's why you get it at a cheaper price and don't have to pay the full whatever this would be. I don't even know. I don't want to get into 40,000 for 100 shares. That's probably really off, but you get what I'm saying. So that's, you can buy these shares and borrow them at a lower cost basis. So that's the whole point of options. So if it was to expire at or this expiration came and the stock price was at 413.47, all these contracts here would expire worthless. They would be worth nothing because of this strike price here. So the strike price basically says where you're borrowing the shares at. What price are you basically saying that you are borrowing the shares at? So depending on what it is, it may be 413, depending on which one you pick. It's completely different for whatever you decide to pick. And so that's the basics of what this is. So in the money contracts will not expire worthless because they will have some intrinsic value, meaning that the price is already pushed through this and that there's some actual value in these contracts. All of this is premium, basically time. You're buying time is basically what you're doing here. And then when they start to go in the money, that's when they actually start to add actual real value in them. If that makes sense. So honestly, it's not that big of a part. I mean, it is if you're going to hold it till the end of expiration, or you're trading contracts that expire the same day, but it's not something that's crucial to if you're going to be trading longer term options or swing trades, things like that. You just need to understand these will expire worthless at the time of expiration. So will these. These will not. These will not. So obviously we kind of want to lean towards this area here where it's either going to right at expiring worthless or in the money where it's not expiring worthless. These are more risky to trade. So that's the idea behind it. So the next thing I want to go over is, so we understand the strike price. This is what you are basically saying you're borrowing the shares at when you buy an options contract. But what you want to pay attention to is you want to focus on basically what number you're buying it at. That's what the most important part is. So like the first thing I got down in my notes here is that you want to focus on basically what number you're buying this at. So you want to focus on numbers. I like to say increments of 5. That's what I like to focus on. So like maybe the 410 contract, that's a more common number. It's a psychological number. For whatever reason, people in the markets like to pay attention to important numbers. Like for SPY, it would be 400 or 410 or 420, no pun intended. But what you want to see is basically you want to be focusing on these contracts that are 415, 410, 405. And these are going to give you the best results because this is what people tend to look at. Because a lot of people like to pick their strike price based on their profit targets. And a lot of the times their profit targets are these whole numbers that like more people would probably have a profit target of 410 rather than 409 or 412. It's just they're rounder, better looking numbers per se. And that's how the market works for whatever reason, but it's how it works. So I don't know how to explain it to you, but that's just how the market works. So the first rule is just pick your contracts based on important numbers like 415, 410, 420, 405, 400, because the whole point of this, it's the same as supply and demand. So like if you're picking a number that most people are probably going to be buying these contracts when they start to see an opportunity, they're going to be looking at the 415, the 410 because of their whole numbers, they're numbers that will stick in their mind more than 413. So with that being said, it's going to increase demand because you're not just buying shares or borrowing shares, you're buying a contract. It's like real estate. When you buy real estate, it appreciates. And the more people that want it, as interest rates go lower, more people are going to be trying to buy your real estate, which makes the price of your real estate worth more. The price of your land increases because more people want it. Or during COVID, when they ran out of toilet paper, prices of toilet paper went up because more people needed toilet paper. So like that's the idea we want to think of when we're buying these contracts. So okay, when more people think the price is going to 415, they're going to start buying these contracts more. The demand is going to increase on these contracts, so the price is naturally going to go up. So not only do you have the stock price working in your favor, but you also have the favor of people wanting these contracts that you're already in and having demand increase in these contracts. And we'll get more into that throughout this lecture here, but understand that concept that you're not just trading options. Well, obviously, yeah, you are just trading options, but it's the quality of the contract that you pick is just as important as the actual trade idea you have based on the chart, right? So that's a concept that I want to make sure you guys understand. So now that we got that understood, simplify that. First rule, pick a number that's whole numbers, like 415 increments of 5. I like to say increments of 5 is something that I would go along with. So 415, 410, 405, and we'll go through more examples later on, but that's the first rule. That's the first thing you want to focus on. pick numbers in increments of 5. And like, here, I'll just give you another example that'll help you understand it a little better. And let me know if you guys have questions when we're going through this in the chat. And yeah. So basically, okay, so for Tesla, if we were looking at this, what would we probably want to look at buying? You'd want see all these are in increments of 5, but think about numbers that are more important to people watching this, right? Or watching this stock. 850, 900, 800. These types of numbers are going to be more interested. People are going to be more interested in these contracts, and you'll start to recognize it as we go through it. So for example, okay, so now we're going to get into the first thing, and then you guys will have a better understanding. So think of nice psychological numbers that people would want to pick up on. Okay, so first thing we want to talk about is volume. Volume is the amount of share. So like when you think about volume, when it comes to a stock price, or just like an overall stock, it's the amount of shares that are being traded within that a certain period of time, right? So that it's the same with options contracts. Volume is understanding this is how many shares or contracts are being traded within that day. This is a live indicator. The rest of these are not necessarily considered live. I mean, the price will vary, right? And that will go up and down throughout the day. But this is the only other thing that will really significantly change throughout the day. So this is something you want to keep your eye on. Like just like you keep an eye on a stock's volume throughout the day on a 15-minute chart, hourly chart, daily chart, you want to focus on the volume of the contracts. So make sure you have an understanding of this. So a simple rule of thumb that I like to look for is over 1,000 volume. That's really it. So that's the second rule that I'm getting to here. And I'll post these rules that I'm going over in the chat after this. But so first you want to pick these good psychological numbers, right? And then you want to pick contracts that have good volume. Okay, so going back to the concept of saying you want to pick good psychological numbers. And we're talking about volume, meaning the more shares traded, the more action is going to happen, the more demand is going to increase in these contracts. When there's more volume, there's more demand. There's more people interested in this and watching it, right? Okay, so the next concept you want to pick up on is, okay, so if we dissect this and look at it a little bit, so let's look at so you would say this is pretty far out of the money, a $900 call. Look at the open interest, or look at the volume, 33,000. Okay, look at the next one, 3,000, 8,000, 3,000, 10,000. Look at how low these open interests are compared to the 900 strike. There's way more of these being traded. So when I would go to look at Tesla and I'm looking to pick up contracts, I'm going to be looking at the 900, the 850. Okay, look at this one. It's $3,000 per contract, but look how much more interest is even in it than all these other ones. Sure, there's an exception, but okay, look at it in terms of all these ones in blue, right? 638, 268, 300, 145, 200, 248, 300. Look at how much more significant this is. Okay, so that's something I want you guys, that's the part of the demand increasing that I want you guys to focus on. So like you see these, this is like proof, and I stayed on Tesla because I saw this initially when I was first looking at it. Like you can see the difference in these strike prices. They do matter. So pick numbers that are psychologically good, that just numbers that would pop in your head first of like, okay, Tesla's trading at 864. What are probably the next two things I'm gonna look at? 850, 900. Those are the types of things you're gonna want to look at. I hope that makes sense. So first rule, you're picking nice hold psychological numbers. And if you can't tell that right off the bat for yourself, just go look at the volume after that. The next rule is number 2, we want to look for something over 1,000. So Tesla is a well-traded stock, right? But so it has large open volume, or there's a large volume. A lot of people are going to be trading this, right? But okay, so if I go to a different stock, like look at this one, for example. There's not a single contract here that's trading over 1,000, right? So that's not something that's not necessarily good. So that doesn't happen with all stocks. So that's why I'm telling you this. It might look like, okay, Tesla's got all of it. Yeah, you can trade a lot of different contracts on here because it's such a well-traded stock. A lot of people watch this. You hear it in the news all the time. And same with SPY, QQQ, IWM, all those things, because they're major indexes, and you're not going to have any trouble trying to trade those. So the next thing you want to go over, we got rule number 1, the psychological numbers for the strike price. We got over 1,000 volume. This more so pertains to day trading, because this will matter, because this is the buying and selling of contracts. This matters getting in and out of positions. Like, you're going to be able to get out of this position easier than you're going to be able to get out of this position, because more people are trading hands with it. Like, this is switching hands way more time. This is switching hands. This 880 call is switching hands way more than the 840 call. So that's something you want to keep in mind. Okay, so that's the first thing. This is more for day trading, but you want to keep that in mind. Over 1,000 for day trading. And then, but this one is going to matter overall no matter what. You're going to want to see open interest of over 1,000. So naturally, okay, look at this. None of these really have an open interest of over 1,000. These two here, and look, imagine that, 850, and then the only other one here is 900. That's not a coincidence. It's because these are the contracts that people like to look at. So that's what you want to do. You want to look for contracts that have that psychological number. But basically what open interest is, it means how many open positions do people have of this particular contract. So for example, like this one has 2,855 contracts currently open. That means 2,855 people have this 900 call open and is in this contract. Now, this doesn't update throughout the day. Like I said, this updates throughout the day. This does not. Open interest does not. This will update in the mornings. It will stay the same throughout the whole day. So basically, it's a tally of what happened overnight. Okay. So I hope that makes sense. Let me know if you guys got questions. You seem like you're understanding it. I haven't got any questions so far. And let me make sure, because I don't even know if I have the chat pulled up. Okay, yeah, we're good. Okay. So the next thing we want to talk about is, okay, so open interest. You want to have over 1,000. That's what you're looking for. So 1,000 for day trading, not crucial when you're swing trading, trying to get out of positions. Now, but open interest, you want to see over 1,000 on the contract that you're getting into, just because that, like, more people, you want to know that other people are looking at this contract. You want to know that you're not the only person with this trade idea. Like, basically, this kind of gives you almost a pretty good confirmation that 2,855 other people have a similar trade idea to you, meaning that they think this may happen. They might have the same trading plan as you. Yep, I can go over those. But yeah, okay. So yeah, basically that's the gist of open interest, right? And then the next part is, let me know if you got questions on this. You're looking for psychological number. I know I keep repeating it, but I want to pound it home so you guys get this. So psychological number on the strike price, volume of over 1,000 when you're day trading, and then open interest, you always want to have over 1,000, no matter what you're doing. This is what you want to have, over 1,000. That's how I pick my contracts. So more is better, right? More is better. Okay, so moving on. The next thing we want to look at is delta. Delta is one of the Greeks. It's the most important Greek because it tells you how much money you're going to make. So basically what this means is 0.50. This tells you how many dollars you're going to make each contract per dollar change. So 0.50, you buy this at the money call right here, the 865. It's going to move $50 for every dollar that Tesla moves. That's the whole gist of what this is, of what delta is. It's pretty simple. Like, okay, so you buy this 900 call, it's going to move $29 for every dollar that this stock moves. So the beauty of options contracts is the closer this gets into the money. So basically, the further Tesla moves up and you own this 900 call, the further this delta is going to increase. So when it gets to, so like when this gets, say you're holding this, you're holding the 900 call and you're holding it, and then it gets to close to 900. You buy it here where it's at 0.29, and then you hold it all the way till it gets close to 900. Now, the whole fact is that it'll be around 0.50 by the time, so your delta will be about 0.50 by the time it gets to 900, because it's increasing and getting closer to being in the money. See how all these gradually increase? That's what we're looking for. So like whenever you get into the contract, if it moves closer to the strike price that you're in, the amount of money you're going to make per dollar also increases. Now, that's one nice part about it, but the opposite side is if you're wrong, the further it moves away, the less money you're going to lose. So say if you bought this, hypothetically, you bought this 865 and it's a 0.50. The further it goes out of the money, notice how these gradually increase, right? It's going to slowly decrease. It's slowly going to decrease in how much money you are losing per contract. So that's a nice part about the delta. So that's something to keep in mind. Okay, so this is basically how much money you're making. The only rule I got for delta is you want to mark off the checklist of the strike price first, then the volume, then the open interest, and then pick the best delta. Like see how okay, so let's go to SPY, right? And this will be an easier example. So let's say, okay, the next number that we really like here, right, is probably the 415 or the 410, depending on which one you want to go for. So what you're going to look for is, and I will let you guys know that this, for like the concepts I'm going over here, don't matter as much for SPY, QQQ, those types of stocks, because look, do you see how drastic these numbers are? Like how, besides when you get up here, but look at how large the volume is and how high the open interest is. Like it really doesn't matter which one you pick that much. So, I mean, the easiest way to go, if you really don't want to, like, it's these rules that I'm telling you don't matter as much. I still play them. I usually just pick, okay, what do I think the stock's going to when it comes to SPY or QQQ, like when I'm trading those things. But what do I think it's going to? Or I pick these psychological numbers. Like the other day I traded 410s because that's what I liked, or that was the nearest whole number. And I just like to hone to my rules, I guess, just to stick with it. It doesn't really matter if it's QQQ, SPY, whatever. I'm just going to stick with what I say. I'm going to do the 410 call because that's the best psychological number right around here. Or I'm going to do the 415. So that's basically how I do this. And so, yeah, that's basically the gist of delta. So delta increases as it continues to go further and further towards the way you want it to go. Same with puts. The further it goes down, the same idea, right? Okay. So then I hope everybody is understanding this so far. So we're going over the strike price. Pick this nice psychological number. Volume, you want to have over 1,000, which when you're day trading, SPY and QQQ, that's really easy. Same with Apple, things like that. Open interest, you want to have over 1,000. Now look at these. But even when you look at, you can still see that it's not as drastic of a change like from Tesla. But like if you look at these, like the 410 has pretty decent, and then it drops pretty drastically. But like the open interest is pretty strong. You go to the 415 or the volume. The volume is pretty strong at the 415, and then it drops off, and then the 420 picks up again. So you can see that it still kind of plays a part. And why wouldn't you, like, even if it doesn't matter as much, you might as well play in your favor. You might as well buy the contracts that people are going to be looking at, so they increase in demand, and then you make more money on it because more people want it, just because it's a better number. So why not just go with it and stick with that rule? Because it's not going to hurt you. Okay, so we've gone through all these. 1,000, nice psychological number. Delta, pick the best delta. Basically, you want to make more money per dollar, so think that way. Pick your contracts that way. It's easier to do it that way. And then, but if you want to load up on contracts, it's totally up to you. But the further you get out of the money, like down here, the more risky it becomes. Okay, so now what we want to look at is implied volatility. And this is the last part of picking contracts. So when you're picking contracts, implied volatility is basically, this is how much, how should I say this? This is how much premium is built, not necessarily all the premium, but this is basically premium built into options contracts. So like for every percent this goes up or down, you're going to either make money or lose money. So like, just like how the stock price moves, every percent this goes up and down, you're going to make or lose money. So there's two different things called gamma and vega, and those two things determine this. And I'm not going to get into those, but I do want you guys to understand that implied volatility controls how contracts work. So now when we're talking about supply and demand, you want to pick contracts that have lower implied volatility, because if this goes, like, this is a lot. If you own this contract and it goes down 23%, you're going to lose money on it, right? You're going to lose money on every percent that it goes down. But if this contract goes to 100%, you're going to make a lot of money on it. And it's a pretty decent amount of money per percent that this changes. So these aren't as volatile in SPY, QQQ, things like that. But basically, this percent right here is the concept of supply and demand. That's what this is. So that's what like when these increase, you're going to make more money. As this increases, the contracts are going to become worth more, even if the contract price doesn't even move. Now, if let's say we have a large pullback and less people are buying calls, then this is going to decrease, and you're going to lose more money than just the stock price falling in itself. So that's the idea. Okay. So that is the concept of this. My only rule with implied volatility, if it's over 80%, I don't typically want to play it. So like, I don't know what Tesla had. Okay, a good example is coin. I always know that one's got ridiculous implied volatility. Okay, so look at this. I would never trade anything like this, because if this went down, like if this went down 1%, imagine if this is what an IV flush is, what people call IV flush. Like, so say they have earnings coming up, the implied volatility is completely jacked up, and then you see that the stock price moves in your favor. You hold it overnight, when earnings happen, it moves in your favor, and then you end up losing money the next day. That's this concept, because all this percent goes down and flushes, and you lose money on the contract because this percent is flushing. So there's no way I'm going to risk my money on something that's already up 220% worth more than it should be. That's basically what it's saying. It's 220% worth more than it should be. So there's no way in the world I would trade this. So like AMD, 57%. This is a little high, but what you can look at is a nothing over 80. That's my kind of rule that I like. Nothing, I will sometimes trade it if the setup looks right, but over 100, I definitely will not trade it. There's not enough upside. You got to see upside in this implied volatility, and you got to see upside in the stock. But when you're picking an options contract, you want to see upside in the value of the contract that can go up, because when demand increases, more people will have open interest volume. This will increase as well. So this will move in your favor. So like when people say, quote unquote, run into earnings, like you're playing a stock that's running into earnings and you see the stock barely even move, but the contract goes up in itself, That's because implied volatility is increasing because it's getting closer to earnings and the move is going to be more volatile. So yeah. So basically that's my rule on this. So we're summing this up here. Strike price with a nice psychological number. Volume, you want to have over 1,000 for day trading. Open interest, you want to have over 1,000 no matter what. You want to pick a good delta because that's where you're making your money, right? And then you want to have rule of thumb, I just say under 80% implied volatility. So that's how I'd pick my contracts. If you guys have any questions, let me know in the chat. There's a couple charts somebody wanted me to go over. I'm low on time, but I'm going to go over these real quick. UAL. Let me know if you guys have questions on that. The chat is open. So, okay. So, yes, this looks fine. This looks pretty good. Yeah, like I like that support bounce or the trend line bounce. But I will say, I did look at the airlines. I already did my analysis earlier, and I will say that I like CCL better. Reason being is because we're at a major support. Like we're at COVID low support. So check that out. We got a bounce here, COVID low support. And then if we drill down to the daily, inverse head and shoulders, shoulder, head, shoulder. So this could easily make a move back up to $13. So that's one thing I'm looking at. So I did look at the airlines, and I think that chart looks decent, but it is kind of in the middle of nowhere. Meaning like it's in the middle of nowhere. Like I would have wanted to get in here or shorted it up here. But it's just not in a place where I'd want to go in and get in. CCL is definitely something I already do have it on my watch list. It's already there. But yeah. So yeah, that's my opinion on that. Charge point. I am looking at this currently. I saw Dark Knight put that in the chat and you guys talking about that bill that was being passed. And I find that interesting. I've been watching this falling wedge for a couple weeks now. And I'm just waiting to see how it plays out. It also has an inverse head and shoulders on the daily. I do think that looks really good. Shoulder, head, shoulder, right? Looks pretty good to me. I like this trade as well. DocuSign, I did look at that too. It's in too strong of a downtrend, and I guarantee you these contracts implied volatility is probably jacked up too. Oh, okay, it's not that bad. It looks like it could break out, right? But I see a lot of more setups that I'd rather play. And look at, you could play the run into earnings right here for next month. You could definitely play that. But I think you definitely could. Actually, yeah, I do like this. It has really good support at 70 or about $70. Yeah. Okay. I like this one. I might add it to my watch list. DocuSign. It wasn't a very strong downtrend. So I do want to see it hold first. I'm actually going to set an alert before, and I'm not going to add it to my watch list. So I'm going to set an alert to watch it later on. Gap to fill, broke resistance around 70 area. Yeah. Yep, that's what I'm seeing as well. I like the support right here, this weekly support. You guys know how I love to play all weekly supports, especially strong ones. So yeah, I do like that one. I got an alert here. If it comes back down to it, I'll hop in. Most likely. We'll see how it reacts when it gets there. Okay, so I'll go over this one. I'll go over a couple of charts and then I gotta go. These are the charts I'm looking at. Strong support here. You can see it had a huge. I don't even know what this ticker is. It's in the NASDAQ 100. But it had a nice move. Every time it's came to this area, or the past 2 times it's come to this area, it's had a nice move to at least $83. And I'm kind of looking for the same thing. Oversold down here. Earnings is not coming up too relatively. Yeah, October. It can't make low. It hasn't been able to make lower lows. And it's bounced pretty hard every time. You got a nice hammer, and then a third. Just a lot of wicks coming down here and a lot of buyers stepping in, and you can see through the volume that buyers are stepping in. And then another inverse head and shoulders, and this one's really pretty. This inverse head and shoulders. So that's why I like this one. Shoulder, head, shoulder. It looks really good to me. And I also noticed, here's a little application to the contracts deal. September, look at all these contracts are crap except for the 70. It's almost 2,000 open interest, which I find very interesting. So I will most likely be getting in this week. And I like it for a move up to $83 for sure. And then I'll go over one more, and then I posted the rest in the chat. JPM, okay, I'll go over two more. Okay, so I love this one here, falling wedge. A lot of banks have already broken out. It's holding support, hammer with strong volume. Another thing, so like if you look at other ones like GS already broke out, BAC already broke out. Wells Fargo, I don't know if it has or not. Yeah, it has a little bit, but it looks like it's coming to looks like it's coming to resistance. Well, anyways, yeah. But all the rest of these are breaking out, and so that's why I like JPM. It looks like it's bottoming out, can't make lower lows, and it looks like it could easily make a move to 130 again. So that's what I'm looking at for a swing for the new my other account that I'm doing. And then one more, and then I gotta go. Amazon, this is just an insane resistance level. So I'm willing to take this any day. With the market being pretty overextended anyways, and heading up to really strong support at 4,200. I really like this for downside. Just because we can bounce here for years. Like this is years. Yeah, this is almost 3 years of price action right here. No, about 2 years. So that's what I'm looking for. I'm looking for a rejection here and playing the downside. It's got a large gap to fill all the way down to 122, and that's what I'm looking for. And yeah, that's it. Let me know if you guys have questions. Hit me in the chat, but I will have this posted tonight if you guys have questions. Thank you for coming, and yeah, next week we got another webinar, and I'll let you guys know. Peace out.